All right, let's crack open this explainer and completely decode the hidden footprints of institutional algorithms. We're going to fundamentally transform the way you read your charts today. If you've ever felt like the market is, actively hunting your stop loss, well, you're about to find out exactly why. And more importantly, we'll cover how to use smart money confluences to turn the tables on the very institutions hunting you.
First, we have to shatter the grand retail illusion. Price action? It is absolutely not some random walk. Markets are highly engineered environments. They don't just move randomly, they move systematically. They are constantly hunting for liquidity to fill massive institutional orders.
And this is exactly why we use smart money concepts, or SMC. Think of SMC like a decoder ring. We use it to stop reacting to random price fluctuations and actually start tracking the massive order flow of banks and hedge funds. It's all about decoding those specific footprints on your charts so you can anticipate exactly where the algorithm is going to target next. So, here's our blueprint for today. We're going to cover the smart money illusion, decode those institutional footprints, and break down structural shifts and breakers. Then, we'll bring it all together by looking at the power of Confluence, the famous unicorn setup, and wrap up with systematic execution and risk.
Okay, let's jump straight into part 1. The smart money illusion.
We need to start with a major pain point. Picture a strong support line on your favorite chart. To you, it probably looks like a solid brick wall, right? But to an institution, that line is just a massive, vulnerable pool of stop-loss liquidity. Your stop-loss is literally the exact counterparty liquidity that these institutions need. They will intentionally drive the price down right through that support just to sweep those stops. Why? Because it allows them to fill their own massive buy orders without causing market slippage. It's a trap.
Which brings us to part 2, decoding institutional footprints. First up in our footprint toolkit is the liquidity sweep. Visualize a previous swing high on a chart. The algorithm intentionally spikes the price just past that extreme, specifically to trigger resting retail orders. It's an algorithmic hunt, a trap designed to trick retail traders into executing way too early. Once the algorithm collects all that liquidity, it instantly and aggressively reverses direction.
And when that reversal happens, it's usually incredibly violent. When smart money injects that massive volume, they leave a physical structural void in the price action across 3 candles. We call this a fair value gap, or FVG, because the price jumped so insanely fast the buying and selling simply didn't match up efficiently. This gap acts like a giant magnet on your charts, a zone the algorithm will eventually seek to fill and rebalance.
Let's move right along to part 3, structural shifts and breakers.
Now, before a market actually shifts direction, we often see an order block. That's usually the last opposing candle before a massive move. But listen, to actually validate it on your chart, it must meet 4 very strict criteria. It absolutely has to sweep liquidity. It has to generate a fair value gap. It must physically break the market structure, which we call a BOS, meaning it pushes past a previous significant high or low. And finally, it must remain unmitigated, meaning price hasn't returned to test it yet.
But what happens when an order block actually fails? Well, a breaker block is a failed order block that gets absolutely smashed through after a liquidity trap. It flips its role from support to resistance or vice versa, causing a violent trend reversal. Mitigation blocks, on the other hand, are much less dramatic. They simply reconcile unfilled limit orders to continue a trend after a standard failure swing.
The absolute key difference here really comes down to the trap itself. A breaker block literally requires a prior liquidity sweep. It has to intentionally trick people before that reversal happens. A mitigation block, not so much. That just happens when the price loses momentum in a failure swing and doesn't actually sweep that extreme liquidity at all.
So we have the puzzle pieces now, right? Sweeps, gaps, order blocks, breaks of structure. But if you trade these in isolation, it's a fantastic way to basically donate your account balance to a hedge fund. The real question is, how do we stack these specific chart mechanisms to mathematically shift the odds in our favor? We have to trade institutional confluences.
And that takes us right into part 4, the power of Confluence.
This is your ultimate confirmation matrix. Step 1. The liquidity sweep sets the trap. Step 2. A massive displacement causes a break of structure, or BOS. This shows clear institutional intent and leaves behind a fair value gap. Step 3. Price retraces back into that FVG and the originating order block. Waiting for this exact chronological sequence filters out so much market noise. It enters you precisely when institutions are actively defending their newly accumulated positions.
Let's look at the ultimate example of this in Part 5, the unicorn setup.
This setup is basically the holy grail of Confluence. You have a breaker block, and directly overlapping it at the exact same price level is a fair value gap. It provides dual institutional resistance, and it's incredibly rare to spot. To validate it, you need a break of a swing, a breaker block forming right at that broken swing, and an FEG completely engulfing it.
So picture this playing out live for a short entry. Step 1. The market sweeps buy-side liquidity above an old high. Step 2. An aggressive downward shift smashes through the prior bullish order block. That creates a bearish breaker block while simultaneously leaving a bearish FEG right on top of it. Step 3. You target your short entry exactly inside this overlap. When you do that, you are mathematically aligning your crosshairs with the single most heavily defended institutional zone on the entire chart.
All right, finally, Part 6, Systematic Execution and Risk. Because honestly, none of these incredible chart setups matter if you don't execute them systematically. You must anchor your lower timeframe entries to the macro trend. First, clearly define your higher timeframe bias. Then, mark your premium and discount zones, and remember, never buy in a premium, never sell in a discount. Finally, you execute strictly during high-volume time windows, like the London or New York kill zones, waiting patiently for that lower timeframe structure shift to align perfectly.
And your math has to be flawless. We use a dynamic position sizing formula. By dividing your account risk by the exact pip distance of your stop loss, you ensure your absolute monetary risk remains flat and completely controlled. This holds true regardless of how incredibly wide or tight the stop loss is on any particular setup. The crucial takeaway from that formula: you have to restrict your maximum risk to just 1 or 2% per trade. This is the only way you survive the inevitable losing streaks. If you risk more than this, I promise you, even a perfect unicorn setup won't save your account from a string of statistical bad luck.
But when you pair these dense, overlapping confluences with a strict 3-to-1 reward-to-risk ratio, you create a robust, highly profitable statistical edge. When you're making 3 times what you risk just by identifying these heavily defended institutional zones, your trading transforms. It goes from wild guessing into a strict, calculated operation.
You now have to blueprint to stop guessing and actually start anticipating institutional order flow. The footprints are all right there. You know how to find the gaps, spot the sweeps, and stack them into high-probability confluences. So I'll leave you with this. When you open your charts tomorrow, are you going to be trading as the hunter, or are you still going to be the liquidity?